Hello and welcome. Today, we're unpacking one of the most valuable skills in investing, fundamental analysis. Have you ever wondered how investors determine a stock's true worth beyond just the price? In this video, we'll walk you through the basics, explore advanced concepts, and help you learn how to analyze stocks like a pro. Let's dive in. Section 1. What is fundamental analysis? Fundamental analysis is about understanding a company's financial health and determining its intrinsic value. Unlike technical analysis, which focuses on stock price movements and patterns, fundamental analysis looks at the company itself, its revenue, expenses, assets, and overall market position. Why does this matter? Because it helps investors spot real value and avoid getting caught up in hype. Section 2. Revenue and profit. Let's start with the basics. Revenue, also known as the top line. This is how much money a company brings in through its operations. But what really matters is profit, or net income, how much money the company keeps after covering all expenses. Look for steady revenue growth. That's a sign of a healthy, scalable business. Declining revenue could point to weakening demand or market saturation. Also, pay attention to profit margins, gross margin and net profit margin. These tell you how efficiently a company manages its costs. For example, if company A has $100 million in revenue and a 15% profit margin, it earns $15 million in profit. If its competitor has a lower margin, company may be more efficient and more profitable. Section 3. Expense management. Now, let's look at expenses. These include operating costs, administrative expenses, and interest on debt. A good sign? Expenses growing in line with revenue. A red flag? Expenses rising faster than revenue. This could indicate inefficiencies. A key metric here is the operating margin, how much revenue remains after covering operating costs. Compare this with industry averages to see if the company is competitive. Section 4. Key financial ratios. Now let's talk ratios, powerful tools for fast analysis. P/E ratio, price to earnings. A low P/E might mean the stock is undervalued. A high P/E could suggest it's overvalued. But always compare within the same industry. P/B ratio, price to book. A P/B under 1 can mean the stock is trading below its book value, but check the quality of those assets. Debt to equity ratio shows how much debt the company carries. A high ratio equals more risk in downturns. Companies with lower debt are generally more stable. Free cash flow, FCF. This is money left after capital expenses. Positive FCF equals money for expansion, dividends, or debt reduction. Dividend payout ratio. Great if you're into dividend investing. It shows how much profit is returned to shareholders. A sustainable payout is key. Section 5. Industry and market position. Don't just look at the company, look at the industry. Ask: is the industry growing? Does the company have a competitive advantage? Look for strengths like brand recognition, unique technology, Patents. Market share. These qualities often make companies more resilient and set them up for long-term growth. Section 6. Final thought. So, to wrap up, fundamental analysis gives you a clear picture of a company's financial health, growth potential, and long-term value. It helps you make smarter, more informed investment decisions by looking at the business, not just the stock chart. But here's the key. Combine fundamental analysis with technical analysis. That way, you know what to buy and when to buy it. Have questions? Drop them in the comments. We would love to hear from you. Thanks for watching. If you like our video, do subscribe, click like, share as the motivation for us to produce more videos.